Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Mike, thanks for taking some time to join me on the podcast today.
Hi, Owen. How are you?
Yeah, I'm good, mate. I'm good. I'm really excited to get into some of these, I guess, ideas around how you find companies here in Australia, and also, I guess, some of your opinions on the Australian ethical process. And we're going to pull apart, what you look for in companies, how you identify those companies, and then what you do to position them in the portfolio. Well, I thought before we start off, I would ask you some icebreaker questions because this is your first time on the show. And these are kind of just like rapid fire questions, mate. So I'm going to try and catch you off guard here.
I'm scared.
Okay, the first one's pretty easy. What's the best investment you've ever made?
Oh, look, I'm going to sort of say Australian Ethical shares below $1. When I joined Australian Ethical in about 6 years ago, and they're sort of currently around the $9 level. I put a little bit of money into Australian Ethical at that point, so that's been a great one.
Wow, yeah. Well, I've just checked it. $8.96 at the time of recording. So that's an 8 or a 9 bagger. So you're sitting pretty on that one.
Yeah, it's certainly been a good one. So the business is, I think you will have followed the company. Obviously it's going really well. So it's an exciting time to be part of it.
Yeah, for sure it is. And that's one of the things that we spoke about with Stuart was that it's great because as Australian Ethical is publicly listed, investors can look at the company and see what the company's doing, but also then become investors in whether it's inside super or outside of super. Okay, now that I've given you the easy one, that's the softball. The hard one is, what's the worst investment you've made?
Look, I'm going to give you one that sort of, you have those investments that sort of stay with you. I don't know if it's the worst investment I've ever made, but I remember in the early 2000s, we invested in a company that's no longer listed called Main Nicholas. And they were an old hospital kind of conglomerate run by a guy called Peter Smedley. And it was one of those stocks that, it was a real lesson to me as an earlier or junior sort of analyst, because the company came out with a very bullish guidance, and I placed a lot of conviction in their guidance, and they subsequently retracted that guidance very quickly. And I remember the stock sinking like a stone and that sort of sick feeling. And it was just, I guess it was a good lesson. And I think one of the things that happened in that particular situation was the company had actually misunderstood its customer base. It was running hospitals, and it thought that the patient was the customer. Really, in their case, it was the doctor who was the customer, and they really went off track. So that was a blast from the past.
Hey, I might just follow up on that, Mike. What do you mean by the doctor was the customer?
Well, if you think about a hospital business, obviously hospitals are a business as well as providing a great social good. Really, how do they make money? They make money by filling their operating theatres or managing capacity utilisation effectively, and they're building operating theatres and then bringing doctors in to utilise those theatres. And so what Main Nicholas did is it sort of thought, well, we're going to cut the costs of all those sort of supplies that we provide those doctors with, and we're going to tell them we're going to run this with a very commercial mindset. And I guess there was another lesson in that situation, because it was about companies also need to have some sort of a social purpose or a positive impact. You can't just run a hospital as though the only thing that matters is the bottom line. You actually have to run it as an entity that's looking after all stakeholders. And the doctors actually revolted in that case, and it caused a lot of damage to the business. And I'd contrast that with a company like Sonic Healthcare, which has obviously been a extremely successful company, but it's always put sort of clinical excellence at the forefront of what it's done.
Fascinating. Okay, I haven't thought about it in that way. The doctors are actually the customers. Okay, great. The third question I wanted to fire away at you is, who is the investor that you read the most?
Yeah, look, I don't read a lot of investment books. I kind of have the view that it's better off working on a sort of a specific opportunity, or picking up an annual report and really getting to grips with the situation, just because investment is such a dynamic thing. And every case is different, right? So we've all kind of read some of the classics, the Benjamin Grahams and the Warren Buffetts and things. But once you've got the fundamentals, I prefer to try to apply it to a specific situation. Something I do a lot is talk to my colleague Andy Gracie, who runs the Australian Shares Fund, and we spend a lot of time just, I guess, as he does with other members of the team, debating ideas, thinking about ideas, reflecting on different management teams, and that's quite a sort of an intuitive process. But I did bring along one book that I thought was quite interesting to share with you. I read this book called The Art of Performance by a guy called Josh Weitzkin. And I think that's an interesting book because the guy was a chess champion, and they went on to make a movie about him. And then he became a martial arts champion, and he wrote this book about how to apply different methods of learning and different types of learning to different situations. So that's an example of a book that's influenced me.
Yeah, right. Okay. I've never heard of it. That's fascinating. And I'll find it online and put a link in the show notes. It's really interesting because you're basically, what if I could paraphrase, correct me if I'm wrong here, basically what you're saying is spending time focusing on developing that pattern recognition of companies and identifying what works with business models and people, rather than spending more time on like the strategy and the kind of the theory behind it.
Yeah, well, look, I think I clearly the theory of valuation and company fundamentals is very, very important. So I don't want to downplay that. But I guess that there's two things that are really happening in analysis. There's a sort of systematic approach to analysis, and you see you do need those fundamental tools. But then you do also need that sort of gut feel, intuition. You need a bit of bravery. Because very often in this game, things go wrong. It's very rare that, you buy something at exactly the right time. Often it goes wrong before it goes right. And so you do have to, through time, if you don't have them innately, develop some of those traits, or hopefully you get them from a team environment too. You have team members that are kind of pointing you in the right direction when you might be getting shaky on something or losing conviction on something. But it is a dynamic game, and I think it's just something we're trying to get better at all the time. There's no sort of magic formula to investing in my view.
It's so this is a perfect segue into our next question, which is basically asking how you came to be involved in Australian Ethical, and knowing the rules of the game are really important. And I note that you're a CFA charter holder, if I'm not mistaken.
That's correct.
Yeah. So how did you come to be involved then with Australian Ethical?
As an aside, when I did my CFA, I think there were 20 people doing them in Australia. Wow. So okay, and I'm not even that old. Well, I don't think I was that old.
When I sat for, this was before COVID, in the stadiums I did level 1, I think there would have been 2,000 or 3,000 at least.
Yeah, it's amazing, isn't it? It's amazing. Yeah. So how did I end up here? So look, here's the irony, right? My first job was at a place called UBS Brinson in about 1996 as a graduate analyst on the buy side. And I was given the tobacco and gaming sector to cover. And look, you know what? I just really hated it. And it just seemed to me that, you had these companies here that were just preying on people. And even, you could go and meet with the management teams. I think we even had a listed tobacco company here at the moment, Rothmans, if I recall, and you go and meet with them and, the whole presentation would be how to get people to smoke more. Or how to get people, in the gaming analogy, how to get people to play more poker machines in areas where they could least afford it. And look, it really didn't gel with me. Like, I loved being an analyst, but I didn't like being part of that process. And the funny thing was, I went back to uni and did some postgraduate work and just wanted to sort of, decide where I wanted to head. And I did some time in management consulting, and then it happened in the early 2000s. AMP Capital was setting up an ESG fund, and it was, Australian Ethical obviously been around in the ethical space for a long time, but this was, it was a big play by what was a major institution, sadly no more, but at that point in time, and I couldn't believe that this opportunity existed, or even this industry existed. I was just so excited to get in there on the ground floor, and I was there for 9 years, and it was really formative for me.
I think it's, like you said, quite ironic that you started on that side of the fence and quickly pivoted, and this is where you've spent the majority of your time. I noticed on your LinkedIn profile, it's got you for decades basically focused on this type of investing and ethical investing, generally speaking. We had Stuart on the show who talked about the kind of the two pillars of the Australian ethical process. One being obviously the ethical research, which he and the team are working on, and then there's more the kind of the traditional investment side after you get that universe. So I'm maybe to start things off. Do you believe that active, ethical, and investment management is the best combination for Aussie equities?
Yeah, look, I'd hesitate to say the best because, like, I think in everything, right, there's different ways of winning. It certainly served us at Australian Ethical very well over a long period of time, and I think we're really good at it. And look, I think the first thing you kind of got to acknowledge is that you're trying to do two things at once, so it's quite different to conventional investment management in some respects. So you've got quite a different universe, for example, than a conventional investment manager. And now that can be helpful. It can kind of push you into some of the right sort of areas and right sort of companies. It can help you manage some of the risks that other people may not be seeing. But you've also got to be a good investment manager, right? It's no good just saying, okay, now I'm just going to pick a whole lot of ethical companies and sort of hope that they go up through time. So we actually sort of have quite a bit of independence as well as collaboration between the ethics team and the investment team, and we think that's important from a governance point of view, because what we don't want at the end of the day is the investment manager sort of saying, oh, well, I kind of like this company, therefore it's ethical, or the ethical team saying, oh, it's ethical, therefore invest. What we really want to do is find companies that meet our ethical charter, and then within that universe, create a portfolio of companies that we think can outperform through time. And so I think there are a few other advantages that we get in this process, because, a lot of people say, oh, well, you're restricting the universe, therefore, it's not an optimal portfolio. But some things that it's done for us is that we develop deep pockets of expertise in certain sectors. So we kind of know things like healthcare, utilities, information technology really well. I think it's pushed us away from always wanting to track a benchmark. We know we've got this different universe. So we're pretty benchmark unaware in terms of our Aussie equity strategies. And so that's something that's really resonated with our clients. They know what we stand for. They know that we're taking active risk as fund managers, and we think they want us to take active risk. And probably the final thing I'd say is that it has probably pushed us outside that kind of top 20, names. We've even got an emerging companies fund, which invests outside the top 100, which has been really successful. So we have kind of benefited, I think, in a number of ways from that difference. And we're just proud of being different and who we are.
Yeah, and I think one of the things with this Aussie equities is, yes, there are maybe say 2,100 companies on the ASX, but if you exclude some of those sectors that are probably more prone to poor economics in terms of capital intensity and those types of things, you can get that down to a manageable list. But even then, it's still a lot to work through. So if you can develop that deep expertise in these industries, like healthcare, for example, is a very strong thematic, right? So that's a really interesting one. How about then? I guess this is probably the ideal time to ask this question. If an investor is sitting back thinking, well, how does the portfolio composition, let's say of the high conviction fund, how does that differ to a traditional ASX 300 or ASX 200, benchmark?
Yeah, sure. And it's probably helpful to put it in context of our three domestic active equity strategies.
Yeah,
so our longest running strategy is the Australian Shares Fund, and that's an all cap fund. It does invest quite extensively, in the sort of X100 space, as well as the top 100. And that's got a 20-year track record. It's got a really strong track record, and we're really proud of that. And it's a very true to label fund, run by Andy Gracie. And then the more recent fund was the Emerging Companies Fund. And again, that's done really nicely for us and invests outside the ASX 100. And then, the latest fund we launched on the 1st of October is the High Conviction Fund. We launched it as an unlisted trust on the 1st of October. And look, I would really position that as an extension of that capability we have in bottom-up Australian share investing. So really, it's a fundamental product. It shares that sort of characteristic of being benchmark unaware, and it shares that characteristic of being very true to label in an ethical sense. Where it's slightly different is it does kind of contain itself largely to the ASX 300. So we're trying to invest in slightly more liquid, slightly on slightly higher average market capitalisation companies on average. And, as per the name, high conviction, it's a little bit more concentrated than the other strategies. So it's running about 30 stocks, and, our diversified Australian shares fund, is running upwards of 60 stocks. Because it does have a sort of a longer tail in some of those smaller cap names. And what that's allowed us to do is launch the new high conviction strategy as an ETF. So we just launched that last week under the ticker AEAE on CBOE, and that's a really exciting thing for us, because a lot of people do like to invest with us directly, and now they can invest with us directly on the exchange.
And I think this is an appealing feature of the ETF industry as well. As we bring active funds into the mix, we're seeing more uptake amongst investors and even financial advisors who prefer exchange traded products. So it's a really easy liquid way to get into a position like this. We'll talk about the high conviction aspect of it in just a moment, in terms of like portfolio composition and management and that type of thing. But let's start with basically what you're looking for. I know that there are 4 pillars in the investment process, because I got some slide docs ahead of time, and I had a look through basically the process that you're following. And I know from the previous conversation with Stuart that we talk about, excluding companies or including companies into the universe based on ethical considerations. But I know that there are these 4 pillars, or the investment merits that you're weighting and you're judging these companies against. So I'm hoping you can step us through those one at a time. And feel free to use examples as we go through, because I think this is kind of like the meat in the sandwich of the investment strategy. I'm keen to drill into this.
Yeah, that's great. Let me try to give you some examples of each of those. And clearly, there's no sort of secret sauce in business model, balance sheet, fundamental valuation, expected return. These are core tools that you'll find at any fund manager. But I think really it's all to do with how these are applied, as part of a process. And so let me give you some things that we like. Just almost a laundry list of things that we like when we're looking at business models, and we've learned these through time. And one of the very obvious ones is we like repeatability of earnings, right? Or what we call, recurring earnings. So, take a business, we do a lot of work in the healthcare sector. Take a business like Cochlear. Is that a recurring revenue stream? Well, it has been through time, but a lot of that is coming from individual cochlear implants and new sales, rather than what they call the services part of their business. So it's earnings are actually dominated by the sale of implants. Now, if I compare that to Fisher Paykel Healthcare, Fisher Paykel Healthcare have a much bigger percentage of revenue that's coming from consumables. So I would argue I think they're both fantastic companies, but in some respects, Fisher Paykel has a slightly stronger business model than Cochlear from the point of view of repeatability. And then, you can sort of take that analogy to other sectors, where you might look at a contracting company that has one big contract that expires in 3 years. And, I would say there's nothing really repeatable about that business, and that they're the sort of businesses that we don't like. A second one in terms of business models is, we think a lot about scalability, and this often has to do with, a level of IP that a company has, with the ability to get economies of scale. If you looked at one of the big supermarkets, or in a technology company, the ability to go offshore. So, an industry where I guess we don't think has many economies of scale would be, for example, the aged care sector. We saw the aged care sector list on the ASX with great promise. A lot of acquisitions and sort of roll-ups in that space, and it wasn't really clear that 1 + 1 made more than 2. And I think that's because, really they're a services style business. And that's something that, I guess in our process, we do tend to privilege product-oriented companies, because we think product-oriented companies scale better than services. And so, a company like Fisher Paykel or Cochlear, I mentioned before, great product-oriented companies with global edges that have scaled really nicely. That brings me to the third thing. We like companies with high gross margins. We've certainly found that businesses with low gross margins, they can struggle. I mean, it's certainly not the case for every company. You can be a big large scale retailer with low gross margins and do very well. But something like the healthcare space, we certainly like to see a company with high gross margins. And then the final one is capital intensity. So we're very aware of how much capital companies having to reinvest in their business, where they are in that sort of capital journey, and are we getting an appropriate return on that capital? And
Can I just ask one question there, Mike?
Yeah.
Just on capital intensity, how would you measure that, or even just get an insight into that?
Look, a very, you could, for example, you could simply look at return on assets through time, and you certainly can. You find you can see a company that's growing its earnings, but actually its return on assets is decreasing because it's deploying funds in a suboptimal way. I'll give you a counter example. A company we've invested in, the High Conviction Fund, is Downer. More recently, and they used to be a mining contractor, and that wasn't something that really that they were excluded from our universe under ethics charter. They're out of that business, so they're within our ethical universe. But what we really like about this business is that the mining contractor business was also very capital intensive, and so the capital requirements in that business have fallen. And so one of the other ways of measuring that, I guess, is just comparing a company's what I would call sustainable capex. So, a sort of a through the cycle normalized capital expenditure number against what they're recording as depreciation in their accounts. And, in that case, they're recording capex below their depreciation. So we think they're on the right side of that equation.
How about the second thing then, which is the balance sheet? What are you in particularly studying here to get this, through to let's do further research on this?
Yeah, sure. Look, and there's obviously a whole range of things. I mean, this thing about capital intensity obviously plays into balance sheet, right? Because a company that has to spend a lot of capital to sort of replenish itself, that's going to eat into the balance sheet through time. And so I think probably the most important thing about looking at the balance sheet is not looking at it in isolation. It's also looking at it in the context of the particular business and the particular industry. And so, I guess a very obvious example is obviously companies with lower degree of variability in their earnings can sustain a higher gearing. So something like an airport as a good example, although even COVID proved that wasn't necessarily the case. And, there was a situation where those companies were going to need additional capital. So we look at the business fundamentals, how cyclical a business is, I guess. If you're in a cyclical business and you're at the bottom of the cycle and the business is highly geared, well, maybe that's okay if you have a strong degree of confidence that actually earnings are going to go up and we really are at bottom of cycle levels. But, on all things being equal, we do, like most people, would prefer companies that are more conservatively geared. We certainly don't like companies gearing up against what we would call sort of non-recurring revenue streams. We think that's a recipe for disaster. And, you also got to look at, the phasing of debt. And I think, there'll be a lot of focus on that. And now we're talking about interest rates going up. People will want to know very shortly how companies are hedging that debt, and also what sort of pricing power do they have in their core business. Because if you've got a lot of debt and your cost of interest is going up, then, what you're going to need to do is be able to put your prices up. And if you can't, then you've got a problem. So there's some of the things we look at. Does the company own its property or not? Has the company taken very conservative provisions? If it was a financial company, and we also look at things like, apart from the sort of typical ratios like net debt to EBITDA, for a retailer, we might look at fixed charges coverage ratios, because those companies are often very reliant on operating leases in the situation where they don't own the property. So they're just some examples. I think one of the things that were found during COVID with quite a lot of capital raising activity. And so I've been giving you, I'll just follow through on the Cochlear example. They raised a lot of capital because they thought their business was initially under pressure. The business recovered more quickly than they expected. And actually now they've got surplus capital, got net cash on the balance sheet. And, we certainly can find companies at the moment, and we certainly always like them when we do that, very high quality business models like Cochlear, in a sort of net cash position. And we think that's quite a strong position.
Yeah, I remember that Cochlear capital raise, because it's quite substantial and it was very, very well supported. And I thought that it was very unique at the time, right? Because here's a company, unique being that a credit to its, I guess, quality as a franchise and quality as, a management team as well, to be able to pull that off. So yeah, great stuff. Number 3, which was fundamental valuation. This is a question I like to ask because I think some people, particularly more aspiring investors, often come to investing more with the kind of scientific hat on and less of the kind of the artistic hat on, meaning that they maybe think that being a good investor is about being a great analyst, and not necessarily, they kind of forget the investor part and just go straight to analyst and number crunching, spreadsheets, etc. So I'm interested to know how you and the team, arrive at valuations. If you are beholden to them, how you go about that. Anything that you can share there will be wonderful.
Yeah, and look, it's a really good point that you make about that difference between the sort of systematic analyst approach and that sort of artistic or intuitive approach. And you definitely do see successful analysts coming from both ends of the spectrum. So I don't think it's one size fits all. Look, our primary valuation methodology is relatively simple, and we like it that way. It's a PE that we adjust for what we perceive to be the risk of the business, the growth opportunity in the business, and the duration of that growth. And we obviously try to normalise for the economic cycle and for anything else sort of one-off that's happening in the business. Or let's say that we think a company's undergeared, then we want to allow for the ability to re-gear that company through time, or vice versa. If it needs a capital raise in the future, we want to allow for that in setting our EPS, which we then apply this sort of normalised PE to. And look, really, that's just an approximation of a DCF. At the end of the day, a PE that's adjusted in that way is sort of shorthand for a DCF. And in my mind, all these things are trying to get to the same fundamental principle, which is how much money is a company going to give back to you? When are you going to get that money, and what's the risk of not getting it? And so they're coming at that problem, but PE comes at it in a very simple way. And so what we try to do is we have a core valuation, what I call it an adjusted PER methodology, so that we can compare companies to each other. But we're very cognizant that, for example, within a sector there might be another metric that's relevant to that sector. So I'll give the example of the financial sector. Price to NTA, can be quite an interesting metric for a lot of the banks and the insurance companies. And some people in the tech space like to look at EV to sales. I know that some people are quite critical of that metric, because they say that it doesn't allow for businesses that might be loss making forever. But I think there's an intelligent way to apply that ratio. If you have an understanding of what sort of returns a particular model can deliver through time, again, it's just trying to, let's say a company's trading on an EV to sales of 5 times. If you might be able to justify that if you know that it can deliver a 20% EBITDA margin through time, and you can convert that into a sort of EV to EBITDA metric and compare it amongst companies. And that's something else that we do. We certainly look at peer comparative valuations. So if we are looking at the tech sector, we're certainly very aware of where major US tech companies are. And clearly it's something controversial at the moment, because we're seeing a bit of a sell-off in the tech sector, and we do invest in that space. But in general, we're investing in companies that are trading at sort of lower multiples than some of those US companies. So we think that gives us some buffer. And look, the point of all this really, I think, is not, coming back to your original question, is not to come up with a perfect answer, but it's to have an analyst ask intelligent questions and build conviction and level of comfort in what they're recommending.
I might just circle back, Mike, to one point that you touched on there. And I'm just going to paraphrase here, and you can tell me where I went wrong, which is that basically you're rebuilding an income statement because you're trying to get down to earnings, and you might forecast that out, say, I'm guessing, and then you're taking into account the risk of a business. When you I imagine you're discounting that back, or like you have a future value in mind, like the price earnings ratio might be X in Y number of years. When you think about the risk of a business in using that kind of technique, how are you thinking about that? We're taught in academia to use things like CAPM and weighted average cost of capital, and involve like things like beta and all that stuff. So are you thinking that way, or are you thinking more like the business risk and what a business would reasonably trade at? Hope that makes sense.
Yeah, look, it does. And it's a really, really good question. And the answer is that it's a little bit of both. Okay. We do use a CAPM approach. But when we think about the risk in a business model, we're not just purely thinking about correlation to the market, which I guess would be a very purist CAPM approach. So it's very hard to kind of wrap all of the risk characters up in a single number that resonates with people. And so you've got this idea that from some people that risk is correlation or a higher degree of variability. Sorry, not correlation, higher degree of variability than the market. Yep. Other people will say, well, risk is the risk of permanent loss of capital, which I think is a fair definition of risk. And then you've also got things like, okay, if a company's got balance sheet risk, or even you've got management risk, or you think the risk of making a stupid acquisition. So you have all these sort of subjective variables. And look, I think the key is to, I probably prefer to see people having a real conviction on earnings rather than really moving models. I think you can sort of get rid of some of the arbitrariness of this if you sort of constrain your risk assumptions within a reasonable band, and then really try to get a lot of conviction in your earnings. But some of this also gets pulled in at the portfolio construction phase, because you'll have an individual company that might be ranking very well in your particular valuation system. But then, when the portfolio manager comes and looks at it, says, oh, well, I've never liked that industry before. I don't want to back it. Why is it going to be different this time? And so then he's sort of applying a risk overlay, which again is fair enough, right? And unless you're a pure quant manager, most fundamental managers, even if they say they're doing some version of this, right? Because they're incorporating risk in different ways, and it's not just as simple as pushing a button on a calculator. You can certainly have a situation where a company has a very strong expected return, but it's subject to a huge binary trade-off. And so in that kind of situation, you've got to adjust your position size, because you don't want to have 10% of your portfolio in something that's going to be decided on a flip of a coin. Even if on balance, if you can find 100 of similar situations, you're going to do well, but you can't, because most of them are different. Long-winded answer, and I'm sorry, there's not an exact answer on that one.
No, because that leads us perfectly into the fourth point, which is expected return, and you've kind of brought it up there, which is I guess another way to express what we think about it as analysts is like the discount rate is like the expected return is kind of what's our hurdle rate. In other words, what do we need from this company or this investment in order for us to justify them making it? Is that how you and the team think about it?
Yeah, certainly. So as I said, we apply a CAPM approach with a beta, and so we are doing our best to get that in at that kind of valuation stage. So if we do think a company it's not as though we apply that afterwards. If we think a company has an elevated risk profile, it will get captured in that beta, and that will lower the PE that we think is appropriate, as it should, to apply to that company. Because in theory, I'm just trying to think of an example, but the contractor sector trades on a much lower PE than the healthcare sector. Why is that? Because I guess there's a widespread perception that the earnings are less recurring. It's a higher risk sector. Through time, it's probably more variable in terms of a demand profile. So I guess another way of approaching this is thinking through time, what sort of PE is the market prepared to pay for this stock or sector? Is this always going to be a discount sector? Is it always going to be a premium sector? Or it might be neither. It might actually get a premium for good management, like a company like Macquarie or Wesfarmers does, even though they operate in industries where you can certainly find peers that don't have the same PE ratios as those companies do. So yeah, like. I think that's how we try to do it. We try to get it into the valuation as much as possible, but then there's another piece that has to happen around portfolio construction after that, and we've got to look at every bet that we're taking in the context of the overall portfolio.
And that perfect segue into it. So because it's the high conviction fund, I think it will just, I actually really like high conviction funds, because I did a study ages ago when I was studying active managers, and I found that investors that take high conviction bets tend to do better but there's always, the catch. They have to be good investors in the first place, but they should back themselves if they know that they are. And I'm interested to know how you go about position sizing. We've talked about like those fundamental factors. Are there some sort of rules that you have in place, like constraints around that? And I'm guessing there are, because you're basically taking the Australian ethical investment process and rolling that up into something that's high conviction. So there's probably something unique about it.
Yeah, well, look. I guess the first thing, as I said before, is we are dealing with a different investment universe. So you are going to have you're not going to look like everyone else just purely because, like, for example, we have a very small investment in the resources sector and in the energy sector. As you imagine, most of the energy holdings at Australian Ethical are in New Zealand in the sort of hydro and geothermal companies like Contact Energy over there. And then, if we look at the, extractive resources sector, we have a very small ability to sort of play in that sector. And that's because of who we are and what we stand for. So we are quite different. So one thing you are introducing, I guess, the technical term tracking error against a benchmark. Once you sort of accept that, so I think, and then when it comes to the actual, let's sort of put the universe question to one side and then just look at the way we go about investing. I think, we are believers in active, that, when people, pay for active management, they should get active management. We don't really, I think, there's quite a few, historically, there's quite a few funds out there that you sort of pay an active fee for and you kind of get something that looks quite like the benchmark. And funnily enough, you can even find it in the ethical space. It really worries me when you see it in the ethical space or the ESG space, because you sort of go, well, often, you really would expect that sort of portfolio to look quite different than the index. And then, as fund managers, when I look at across our team, we want analysts to be able to express conviction. Right? We think we've got the ability to add quite a lot of value. Why do we think that? Because we do have these deep pockets of expertise in our sectors. So, I've been covering the healthcare sector for a long time. There's other people on the team have also covered healthcare, IT for a long time, financials for a long time. And so we think if you can build up, and it's actually not just knowledge of the sector, it's also relationships, right? So you've got that longitudinal read on management teams, and also that again, that sort of read on where businesses are, and that very long term, it could be 10, 20-year cycle. I mean, the irony about being a fund manager is you typically outlast the CEO of the business that you're looking at. You may even see 3 or 4 when things aren't going well. And so you do hear the same stories and different narratives, and then back to the same narrative again. And so, like, we're real believers in the ability to add value from the bottom up. And we do that, I think, by not necessarily doing it in the same way as everyone else, or just looking at the top 20 or trying to hug an index. When you ask me for rules, like, for example, in the high conviction fund, the maximum position size is 10% in any single stock. We, typically won't probably go that large. The biggest position at the moment is about 6.7%. I think 6 to 7% is a reasonable size go at something. We're not looking at the benchmark, so that could be there could be a lot of active risk in that position. In a company like CSL, which has a big benchmark weight, 0 weight at the moment, or BHP clearly 0 weight because it doesn't. It's not in line with our ethical charter. So index weight doesn't determine where we see the greatest opportunities. I think to some extent, if it's a very small cap stock or it's a binary outcome style stock, clearly that's not going to be a 5 or 6% weight. Analyst conviction is important. You can do all the work and then you sort of say to the analyst, well, it's got a 50% return. What's your level of conviction? And you've got the 3 things here that could go wrong. How do I know they're not going to go wrong? How much work have we done on them? Is there anything else we can do? So you do have to sort of weigh up, are we just guessing here and we've got a chance of being wrong, or is this an area where we can legitimately add value? And then, as I said before, you kind of want to look at the overall portfolio. If banks are all showing positive alphas, well, I don't necessarily want to have 50% of the portfolio in banks. And like, frankly, a lot of people own banks anyway, as private investors. And we think it's actually a strength of our process that we are looking outside that top 20. And so we kind of blend quite well and bring a set of skills that's a little bit different than what people are when they're building their own portfolios.
Mm. How about probably the harder question? So I think not enough time is spent by private investors on portfolio management, and in particular the kind of the understanding the relationship of risks across a portfolio. So how is this risk of this business correlated to that risk? And if you follow the revenue streams and the supply chain, you can typically find the answers to those questions. But one of the things is knowing when to sell. I find that we talk a lot on podcasts and newsletters and in the media about buy, hold, sell, and typically the buy that gets the most attention, not the sell, unless it's really polarizing. How do you think about the common reasons that you might end up selling a position? If you have examples, that would help.
Yeah, sure. Well, clearly, the first point is we're guided by valuation, right? So, obviously, if a company kind of meets and exceeds our valuation, that's a trigger to sell, and we're not afraid. We are typically low turnover, but we're not afraid to sell a stock, even if we've held it for a long time. So, I think you've got to be quite disciplined, and you be quite conscious of where companies are trading relative to each other and international comps, and so forth. But I'm not sure if that's what you're trying to get at, because the really hard question is, clearly things go wrong. So you sort of, you start with a valuation that's pristine and perfect and a view of the world that is perfectly forecastable. And, what typically happens is very quickly you learn that, reality is a dynamic equation. Things don't go according to plan. Companies don't do what they say they were going to do. Businesses are more competitive than you thought they were going to be. And so I think really the hard thing is knowing what do you do when things go wrong, or things don't go the way you're expecting, or even when they go right, because you can kind of be lured into holding a stock for too long, thinking, oh, well, this time's different, it's going so well, when really it's just a dog of a cyclical old company that's going to mean revert in time. So valuation is one thing, that keeps us on track. You're being hit with noise every day, and so you really do have to have a filter. That's a good point. Yeah. What is a genuine kind of game changer for this company, and what's just another thing that is really immaterial, and I don't need to listen to. And it sounds like an obvious thing, but markets are very emotional. You can get very attached to companies, and so it's not something that you really want to do, but you sort of pat yourself on the back when they go up, and go and cry when they go down, and you can make some really terrible decisions. So I think a key one is staying close to the sort of story, and you've talked about sort of investment stories in this podcast, and when that story starts to change from management or from a strategic point of view, I think it can be a tipping point. I'll give you an example. We invested in a company in our Australian shares fund, Australian pharmaceutical industries, and we when Stephen Roach was managing it, and the story was very much organically growth based in the Priceline franchise, and the story changed. He subsequently departed, and then the story changed, but it didn't change overnight. It just changed gradually to one that was actually about more cautious growth in Priceline, and more acquisition focused growth. And they acquired a laser skincare business. They actually made a bid for Sigma, which we struggled to understand, because Sigma was trading at a higher multiple than API at the time, and these things were sort of warning signs, I guess. And we probably, I think one of our biases is we try to kind of buy strategically attractive assets up front, and we had a view that Priceline was an attractive franchise, and ultimately it has this corporate interest obviously in that story now, and I think that position has ended up okay for us, but perhaps we could have put the money to work in a better way elsewhere had we sort of paid attention to some of those signs. So there's an example where I think I was the analyst, I didn't probably pay enough attention to the way the story was changing and the pressure that was putting on the balance sheet ultimately.
Do you, as a team, and when the analysts pitch ideas, do they write a research note and then present that to you?
Yeah, look, so we all the analysts write research notes and model the companies within our valuation system before we make an investment, and that's after, of course, the company's gone through our sort of rigorous ethical screening process. Look, one thing we don't do is we don't spend a lot of time sitting around as sort of a team of analysts and kind of debating whether we're right or wrong. Like we actually place quite a lot of, we've got a team of analysts that are very senior. We've recently hired a more junior analyst, but we've got a team of analysts that are very experienced in their sectors. And so we're quite happy for the portfolio manager and the analyst to sort of jointly make an investment. And that works best for us when it's kind of a collaboration between the analyst and the PM. I've worked in other teams where you do spend a lot of time as a team kind of debating, is, this company XYZ a good franchise or isn't it? And look, that's another way of doing it. I think particularly when you've got a big team or you've got a lot of junior people in that team, that can be an important part of your process. But we sort of find that we can get through a lot of work the way that we do it by sort of trying to streamline that process. And look, frankly, there's always going to be different points of view. And what you kind of don't want in a process is people that know the least about a situation but have the loudest voice having too much influence. So we try to kind of get the experts in the room and then often make a reasonably quick decision once the work has been done.
Yeah, fascinating. I like it. We're going to spend a bit of time in the next episode talking about 3 companies in particular that I know you know very well. So if you're listening to this and you want to hear more of Mike's insights and ideas, stay tuned for the next episode. But I thought maybe, mate, I would finish with 3 questions. The same way we started with rapid fire questions. We'll end with the same. I've already asked you, I guess, which investor you read, but maybe another way to ask this is, what is your favorite book, or even, I guess, going back to like university days or formative days, what is your favorite book on investing, on business, on finance that you've read?
Oh, look, I'll just go with one of the classics, like, The Intelligent Investor. I mean, it's just, you could just keep going back to that forever and not be disappointed. And for me, it's one of those books that it kind of gets you in the right headspace even when you read it. It's just got such profound wisdom, and you think, gee, what was I doing yesterday? I was I wasn't on the right planet. Like let's get back to fundamentals here and really anchor ourselves in sort of how we're going to make money from this portfolio. So yeah, I'll give you that one.
Okay. Number 2 is on the ASX, which company do you think has the strongest brand?
The one I'm going to give you there is Cochlear, and I think even though it's not a like a wide consumer brand in the sense of sort of a Woolworths or something, if you're implanting something into your head, there's obviously an incredible level of importance that it works and it's safe, and and they're just an outstanding company. They don't cut any corners. They've reinvested in their business. They continue to reinvest in their business. Had excellent management teams through time, and they get it right. Now, look, so it's always available on a high PE. It sort of manages to grow into that PE through time, but it's a quality company.
I agree. Okay, final one then. Who is the best CEO you've come across?
Look, I'm going to give you another healthcare example. I think Brian McNamee at CSL, was an extraordinary CEO, and I'm always interested in CEOs where, things don't always go right. You kind of think of the company CSL is now, but there were certainly times when they made some of the acquisitions that set them up for their current success. They didn't work initially, right? They had currencies moving against them. They were under enormous pressure as a management team for having potentially destroyed a lot of capital. But then you kind of look back now at the journey they've been on in terms of consolidating their global leadership position, in the plasma industry. The way that industry has been innovative through time and continued to build. It's not just the fact that they've consolidated the industry, actually the product development that's gone on, and they've been at the leading edge of that, and then into the flu space, and they've obviously acquired another business more recently. But those initial plays were very bold plays. They had risk, and they've delivered. So that's my suggestion.
No, I like it. I like it. Mike, thanks for taking some time to join me on the show today. For those listeners who want to hear more from Mike and see what the team are invested in, you can head to australianethical.com.au. There's a link in your podcast player. You can click that and it'll take you to the landing page for the high conviction fund, and it trades on the CBOE under the ticker code AEAE, which is easy to remember. We've talked about what's the best investment you've ever made, and you graciously said that it was Australian Ethical shares that you bought around $1, which that will get you some praise from the top brass, I'm sure. We talked about how the process comes together through, I guess, the prism of looking at these things like the business model, balance sheet, fundamental valuation, and expected return, and how you weight things in the portfolio. You've brought some great examples to the show as well, mate. So thanks for joining me on this episode. Listeners, will be back next week with another episode with Mike. So appreciate your time, mate.
Thank you very much, Owen. Good to speak with you.